Today, we will talk about risk management in trading. What is risk management? Risk management involves limiting your positions so that if a big market move or large string of consecutive losses does happen, your overall loss will be something you can reasonably afford. It also aims to leave enough of your trading funds intact for you to recover the losses through profitable trading within a reasonable time frame. Risk management is the process of measuring the size of your potential losses against the original profit potential on each new position within the financial markets in order to succeed as a trader. Without a disciplined attitude to risk and reward, it is easy to fall into the trap of holding losing positions for too long. Hoping things will turn around before eventually closing out for a large loss makes little sense if your original objective was to make a small profit over a few hours. It is important to combine these ratios and the relationship between risk and reward. For example, many successful traders actually have more losing than winning trades, but they make money because the average size of each loss is much smaller than their average profit. Others have a moderately average profit value compared to losses, but a relatively high percentage of winning positions. Why is risk management important in trading? Experienced traders know that even trading strategies that have been successful over the long term can leave you vulnerable to risks in the short to medium term, including, there is still, of course, the possibility that the above scenarios can arise even after you have used the appropriate risk management strategies. Losing more than 30% of your account can lead to a major task just to recover what you have lost. After large losses, some traders resort to taking even greater risks, and this can lead to ever-deepening difficulties. To get the benefit of a winning strategy over the long term, you need to be in a position to keep trading. With poor risk management, the inevitable large market move or a short-term string of losses may bring your trading to a halt. You can avoid risk as a trader, but you need to preserve capital to make money. A risk-managed approach to trading recognizes that you are taking risk but need to limit that risk in the short term to maximize longer-term opportunities. Lack of risk management is one of the most common reasons for failure. Margin risk management. Margin trading is a double-edged sword in that it magnifies potential losses as well as potential profits. This makes it even more important to limit your exposure to large adverse market moves or larger than usual strings of losses in order not to trigger a margin call on your positions. Risk management rules can sometimes reduce profits over the short to medium term. The temptation to abandon prudent risk management is often greatest after a period of success, and even a single large trade in these circumstances can easily lose all your recent hard-won profits and more. It is all too common to have a lot of successful trades with smaller positions, followed by the inevitable losses that come along just when you have decided to take on bigger positions. A consistent, controlled approach to trading is more likely to be successful in the long run. Gradually compounding your account by leaving your profits in the account and prudently increasing your positions in line with your increased capital is a more likely path to success than overtrading in the short term. Good risk management can also improve the quality of your trading decisions by helping with your psychological approach to the market. Getting into a cycle of overconfidence followed by excessive caution is a common problem for traders. Trading without risk management makes this more likely. Stop-loss orders. Successful trading involves balancing risk and reward. Good traders always work out where they will cut the loss on a trade before they enter it. Our next-generation trading platform is designed to assist you with a risk/reward approach to trading. You can place a stop-loss order when you open a new position. Stop-loss orders are used to exit positions after the price moves against your position. A sell-stop order is used if your opening trade was to buy and you are long the market. A sell-stop order can only be set at a level that is below the current market price. If the market falls to the stop price you nominate, the order becomes a market order to sell at the next available price. Stop orders are often called stop-loss orders, but they can also be used to take profits. For example, a common strategy is to move your sell stop-loss higher as the market moves higher. This can be easily managed by applying the trailing stop-loss function. A buy stop-loss is used if your opening trade was to sell and you are short the market. A buy stop order can only be placed above the current market price. If the market rises to the stop price you have nominated, the order becomes a market order to buy at the next available price. Some advantages of using stop-loss orders as part of your risk management include: you control your risk and reduce the chance of large unexpected losses that can catch you off guard without a stop-loss in place. You are using a disciplined approach to trading. Placing a stop order makes you consider where to cut losses before you enter the trade. It also reduces the temptation to run losses in the hope of breaking even. It helps you to assess risk and reward. You can measure the profit or loss achieved on each trade against original potential loss. This is the difference between your entry price and original stop price. You may decide not to enter some trades if the profit potential is too small compared to the initial risk. It helps with time management. Stop-loss orders are triggered automatically, meaning you don't have to be glued to the screen monitoring your positions. Risk management strategies. The knowledge that your trading is backed by a good set of risk management rules can be a big help in avoiding the cycle of euphoria and fear that often leads to poor decision-making. Good risk management frees you to look at the markets objectively and go with the flow of the market, confident in the knowledge that you have taken reasonable steps to limit the risk of large losses. Limit your trading capital. The first thing to decide is how much capital you will devote to trading. Many people are investors as well as traders. For example, you may hold long-term assets such as shares or property. Trading normally refers to buying and selling in seeking to profit from relatively short-term price changes. Investing, on the other hand, involves holding assets to earn income and capital gain, often over a relatively long term. It can be a good idea to plan, fund, and operate your investment and trading separately, as each activity involves different approaches to strategy and risk management. What do you think of our video? Let me know in the comments section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.